But I wanted to step back a little bit, Peter, and probably start with you, just reflecting on what we've been going through over the last few years. Cast your mind back to the Banking Royal Commission 5 years ago, but to some it might seem an eternity. Do you think the lessons have been learned?
No, is the answer. I think there is an amazing lack of memory about the Royal Commission and the fact that those banks had a lot of conduct risks which was uncovered, and we are now paying for the sins of that through post-Royal Commission regulation. And in a certain respect, I think COVID actually covered up those misdemeanours where the banks, or the major banks, for one reason or another, managed to gain back a little bit of trust, which I don't think has been earned. And I think that we have an opportunity to actually sort of call out that leopards don't change their spots. So.
You're referring to the deferrals that the major banks provided on home loan repayments and business repayments during that time. You
Correct.
Don't believe that those credits are enough, or perhaps the banks are dining out on those credits a bit too much?
I think that there is a clear difference in the models between our sector and the listed sector, and those differences need to be called out a little bit more clearly. And it's a little bit like greenwashing, and I think that there was a session on greenwashing, but there should be a sort of a purpose washing. And those banks have suddenly jumped on the purpose wagon to say they're all for purpose. If you look at their mission statements, they'll all say they're for purpose. Their sole purpose is profit. And I think they should be called out on that. So where we are the true believers or the true advocates and deliverers of purpose.
But prior to your current role, you've worked for them, so you know what goes on inside the big banks. You know how the sausage is made.
I do, and I do know that those decisions around those tables are made with profit in mind, not the customer in mind.
Saul, I just wanted to get your view on this, looking in the big picture about the banking sector, the financial services sector, taking all your experience into account what we've seen in recent years. Has much been learned, or do we still have big governance issues that need to be sorted out?
It's hard to say objectively what's been learned, but I think the banks have certainly, that is the major banks, have certainly experienced consequences of the failings that were exposed by the Royal Commission, and with one exception, the chief executives of the banks at the time have lost their jobs and have been replaced by people who are still, very well paid by community standards, but nonetheless paid less than their predecessors were. I think, and I agree with Peter about this, that the banks did seize on the opportunity which the COVID pandemic presented to redeem their standing somewhat with the community by not only exercising considerable forbearance with borrowers who would otherwise have been in financial difficulty, but being a safe place in which people could stash over $400 billion of savings that they made during that period. Now, presumably mutuals and cooperative banks saw a share of that as well. Banks have got out of the businesses where their behaviour was worst, that is in wealth management and insurance, particularly life insurance. They've got out of those businesses, and they're just not as visible, commenting on as many things as they had been. I think prominent people who worked for banks have still to some extent under instructions to keep their heads down a bit. Now, banks are facing a different set of challenges in present circumstances, and there are opportunities for organisations who are motivated by purpose rather than profit, again, to distinguish themselves from profit-making institutions, in particular, for example, by the speed with which they pass on to their borrowing customers as opposed to their deposit customers increases in official interest rates. And there's, while it's a challenging time for smaller financial institutions who don't have the scale that's necessary, for example, to write lots of mortgages, or to write lots of business loans, there are certainly opportunities in the present environment for smaller and mutual institutions to distinguish themselves by the way they conduct business and the way they treat their customers.
Given what we're seeing coming down the track, Peter, with a lot of fixed rate mortgages, having those terms expiring, households in distress from 12 rate rises since May last year, do you think that some of that goodwill is going to start wearing off if and when banks have to start dealing with delinquencies and defaults?
I think the so-called mortgage cliff, I actually do think it's a thing, but I don't think it has fully played out yet. And I think that the peak of that is probably next month to the end of the year. You put a couple of interest rate rises, Sol would be better placed to talk on this, but we would predict one next Tuesday. And that will take 4 to 6 months to play through until it really starts to hit with the other pressures on household living expenses. So people will do a lot to keep their mortgage payments up, but that is going to become a little bit trickier, but I don't think that will start to play out probably until March to June next year. So you've got this period where every bank's book's in very, very good shape. So they're starting off a very good base. There's still a lot of savings in the system. There's still a lot of people ahead of their mortgage payments, but that stress will start to come through, but it won't start to come through in bank behaviour, I don't think, until June forward of 2024.
And Peter, despite the stresses, there's still a very competitive environment out there for loans, and the major banks are doing whatever it takes to get to sell new loans. But what about the issue of serviceability buffers? Because APRA, the banking regulator, has made the point of lifting that to 3 percentage points above where a loan's lent out. But is that a level playing field when you're competing with the major banks and if you're a mutual?
Not really, but it's also a question. I don't think you can look at the serviceability buffers from APRA's point of view until you are reasonably certain that you've got a terminal cash rate, and I don't know where that terminal cash rate is. But I think you've seen some majors play around with that serviceability buffer to take it down through refinance, and I think there are very good reasons why you do that for your existing customers. But to take that serviceability buffer out now when you've still got some uncertainty about the RBA's position on inflation, I think that would be an ill-timed move.
Yeah. And just on that terminal rate, Saul, we're at 4.1% at the moment. Might be 4.35% on Melbourne Cup Day, but we've seen other major central banks around the world with rates much higher. I think it's Canada 5%, New Zealand 5%.
5.5%.
Yeah.
The Fed's 5.25%.
Yeah.
Even the European Central Bank is now 4.5%, which is above ours.
So the Reserve Bank of Australia still has some way to go.
Well, not necessarily. I mean, there are some reasons why our cash rate can be lower than otherwise comparable countries abroad without that necessarily meaning that the Reserve Bank is any less determined to wring inflation out of the system. The first is that in Australia, notwithstanding the increase in fixed rate loans that occurred when rates were at record lows, the vast majority of borrowers here are at variable rates, in contrast to the US, where they're all at fixed rates. In Canada, where they're mostly at fixed rates, albeit for shorter periods than in the US, or in New Zealand, where fixed rate loans, albeit typically for 2, 3 and 5 years, are much more commonplace than they are here. So monetary policy, although it works with a lag, and I don't disagree with Peter's assessment of the lags that are in the system at the moment, it works more quickly. People feel it more quickly than they do in the US, where most people wouldn't know what the Fed funds rate is.
And they have fixed rate mortgages.
Correct.
30
correct.
years.
30-year fix. So if you're not planning on moving, then you just stick with the rate you took out at the time. So that's one factor. The second factor is that the spread between the Reserve Bank's cash rate and the rates that borrowers actually pay is wider in Australia than in most other countries, which is one reason why our big banks are as profitable as they are, because the net interest income they they make is bigger. A third reason is that our inflation target is a bit softer. So our target is 2 to 3% on average over the course of the cycle. New Zealand, Europe, the Euro area, England and Canada, their target is 2, and there isn't a let out for on average over the course of the cycle. And the final factor, I think, is that the Reserve Bank just doesn't seem to be in as much of a hurry to get inflation down as quickly as other central banks are. So although I changed my mind yesterday when the inflation figures came out and were more than I thought, more than the market thought, more than the Reserve Bank had forecast, that Michelle Bullock has introduced her own words of low tolerance for unexpectedly high inflation. She didn't inherit those words from her predecessors, so I assume she means it, and she'll probably need to back it up. But I would think the terminal rate, that is the rate at which the cash rate peaks, could well be 4.35%. It certainly won't be 3 percentage points above where it is today. And it sometimes occurred to, I thought this when interest rates were at record lows, that although the Reserve Bank often says, and most people think it's only got one tool to play with, to stimulate the economy if it needs it, to restrain it if it needs it, which is the cash rate, there are in fact other tools that could be used to avoid adjustments in interest rates, and one of those would be the serviceability buffer. I think APRA was right to increase that to 3 percentage points when the cash rate was 0.1, because it was highly likely that at some point the cash rate would be 3 percentage points higher. It's pretty unlikely today that the cash rate will be 3 percentage points higher than it is today. I think APRA was asleep at the wheel with some of their other prudential guidelines during that boom that drove house prices up through the roof. APRA could, and in my view should have, done more to rein in the rate of growth of mortgage lending, and had they done so, there probably wouldn't have been as many people who will be experiencing financial difficulty, especially when they come off those fixed rate mortgages.
And on that serviceability buffer, I was wondering from your experience, Peter, whether, given the old serviceability buffer of 2.5 percentage points going up to 3 percentage points, the onus is on borrowers to be upfront and honest about their ability to service a loan. Then on the other side, the banks have got to do all their checks and balances, which is, as we know, are quite onerous these days. Are there going to be cases where people will have been caught out because they haven't told the entire truth, or banks maybe haven't done the right due diligence on borrowers?
Yeah, of course there will be. This happens through every cycle. So people will do what they think they need to do to secure the lending, to put a roof over their heads in most cases, or be stretched to buy that investment property or something of that sort of nature. So there's always a bit of gilding the lily that goes on. You are correct in saying that the bank's responsibility is now to prove the serviceability calculator, and the unsuitability of the product is much, much higher than it used to be. But you are still you can only go so far in that checking. But when you look at the overall, or our concern about the book, whilst that might happen, the number that we actually look at is the unemployment number, or the employment number, with the belief that while that number is healthy, people have jobs, they will do what needs to be done to keep their homes, or to keep from going into default. When that number starts to move, which the RBA probably wish to see it move, then I think you've got a little bit more pressure coming into the book, and that's when we'll be paying a lot more attention.
I guess with some of the reputational problems that the major banks have had in recent years, and even some now, Peter, what opportunities are there for mutual banks like your one, for example, given with those reputational issues that we all know about? I mean, the point of difference that's going to encourage someone to want to go through a mutual rather than a major?
It's a very hard question, and one that all of us in the room, speak about and try and tackle, because we didn't see the mass exodus of customers out of majors with bad conduct into the mutual sector. We certainly were a net beneficiary of it, but maybe we weren't able to capitalise on that as we should have. But some of that comes to our model, because our model is very disparate. We have small credit unions where we are, if I say credit unions collectively, we're lacking in scale fairly well, and we are dispersed around the country. So we haven't had that ability to create that national alternate. And there hasn't really been these iconic national mutuals in the market since the early 80s. If you
It's
look
like
at,
this national or federated model.
no, I'm talking there about, if you look at the icons in the market, 30 years ago, 40 years ago, you had AMP, National Mutual, Colonial Mutual. These were insurance, but they were big mutual insurers, and they were seen to be good corporate citizens, and they demutualised through the late 80s, early 90s. That didn't work out particularly well for shareholders in the end, customers, staff or communities. But there hasn't really been a national alternate. I think the opportunity to create that swell, or maybe that groundswell, is to realise that 5 million Australians choose to bank with a mutual. But if you have these mutual brands like Great Southern Bank, Bank Australia, Beyond Bank, our new bank, creating this platform that will say there is a national alternate. They are national distribution strategies that people can say, oh, I realise where that brand is now, and I don't have to think about, well, I've got to be a policeman or a fireman or a nurse. I can see there is an alternate model.
You've just been through this very big merger with Heritage and People's Bank.
People's Choice.
People's Choice, sorry.
Yeah, People's Bank
Choice.
sounds like it's sort of
Yeah,
Chinese.
okay.
Yeah.
Right, okay. Not trying to rebrand.
Although there are a lot of potential customers there. For
But do you see more mergers coming up?
Yes, I do. In the sector, so I would see that scale is a requirement of the sector, but there always is going to be a niche market for smaller players or for bonded players. But scale isn't going to be driven because of a desire to have a bigger balance sheet necessarily. I think it's going to be driven from technology. You're going to require significant investment in new technology systems to keep abreast with the competitive nature of digitisation, the customer's expectations in that of competitive, contemporary and secure products. And that requires an enormous amount of investment. And to achieve that, I think that's what is the driving factor of...
Yeah, I'd like to come back to you about that investment and the digitisation a little bit later, but I was just going to ask while we're on this subject, Saul, having your exposure to the banking industry, the clients that you work with, how important is it for competition in Australia to have this thriving mutuals banking sector?
Well, it is important, not least because in a small but tangible way, you represent an alternative that people can turn to in the event that they either, from their own individual experience, have had an unpleasant experience in dealing with one of the major banks, and there are certainly plenty of people who do have that, or in the event of there being something more systemic affecting the major banks, perhaps because of their overseas operations that are more purely locally focused institution, like some of the smaller mutuals and cooperatives do represent an alternative. And this applies not just in financial institutions, but in retailing, for example. And it's one of the characteristics of the Australian economy that is not shared by all of our peer group, and I think does have some broader consequences, that our economy has become very, to use an economist's term, oligarchical. Because we don't have many industries that are monopolies, where one single firm dominates it, but there aren't many industries which aren't dominated by, say, 4 or 5, or 2 or 3 firms. Media, airlines, supermarkets, banks, insurance, transport. I could go on, and I think it's incredibly important, not just from the point of view of imposing some discipline on the pricing and other behaviour of the big players in individual industries, but also for things like innovation and productivity growth, that there be potential rivals and competitors who, though small at the moment, could become much bigger if the big players get something wrong and the small ones do something right.
But I guess, from your world, Saul, or your past world, when you're looking at banking boardrooms and people who are looking at for profit and they hear for purpose, I mean, how is that viewed? Is that a reality where you can make money but be for purpose and make money for your members?
Well, I think the health of the mutual sector, which has been on display here over the last couple of days, says that you can do that. I mean, you're not going to make as much money as a for-profit operation, but then you wouldn't be doing what you were doing if that wasn't your sole motive.
If I could just make a comment on that, we think for purpose is a very viable proposition. We all would share that. We don't necessarily think it's got a premium to it though, but we think that if you have a competitive product that is as same features and benefits, same price, same security on it, one is for purpose, one is for profit, I think people will make the choice to bank or choose a product that reflects their values. And that's what we have to be able to articulate and show that the value proposition rests with the consumer's values, and our values are aligned. And I think we've heard from other speakers saying this is a time for the cooperative and mutual sector to capitalise on that.
And which brings me back to the digitisation. So for purpose, for members, but I remember doing a story with the ABC maybe 20 years ago about banks and their systems, and I think it might have been the Commonwealth Bank. They had a different IT system for each silo, and they spent an enormous amount of money bringing it together, but by the time they had it all done, they had to start again. And all banks go through this, but in a bank, like People's Choice, I mean, it must be a bit like painting the Sydney Harbour Bridge. By the time you get that sorted out and get to the end, you really have to start reviewing what the next phase is going to be, I suppose.
So the systems of major banks, the legacy systems of major banks are a nightmare. So no matter what anybody tells you about the majors, none of their systems talk to each other. And you might have a nice sort of coating over it, veneer over it to make it seem like it's one system, but in reality it's not, it's many. So the trick, and I think the success of mergers relates or revolves around a single tech stack. So if you can do that and simplify your business, this is our model, the Heritage and People's Choice model, is to go to a single new stack. So getting rid of the technology debt that exists in the two legacy banks, and then creating a new stack, which is contemporary, repeatable, and secure. So that is cloud-based. It's very, very expensive to do that. But once you have got that single stack and a simple model, you can drive your cost to income ratio down, and you can repeat and get the benefit of that scale. So there's not too many banks that do have that ability. But if you're looking at the merged opportunities, that's probably the opportunity you're looking for, is to get banks together that can get rid of their legacy IT. It would create some costs in doing that, but if you can go onto a single stack, then that's where you'll get the benefit.
Right. And Saul, I was just going to ask you about this as well, that we're talking about security and IT systems, and now we've got scams and organised crime. Just from your point of view, what sort of risks does this pose to banking as we know it, given that, banks really don't, no bank has a solution, do they?
I suspect it is one of the biggest risks that financial institutions face today, not just of financial loss, but the reputational consequences of, for customers' confidence in financial institutions as a custodian of their saving. It's probably one of the biggest risks that financial institutions face today, and you will never get completely on top of it because the people who are the scammers and the crooks, are clever and crafty and inventive and probably, they're in it for purpose as well. It's a very malicious individual purpose, but they're motivated
purpose.
to do what they do. So it's an ongoing, I think, challenge.
Now, everyone has been here patiently listening to us talking about monetary policy and the way that banks operate and the rest, but I was hoping that we had time to take some questions from the audience because I'm sure that you would have some. And I understand there is a microphone going around. Here we go, up the back there. So if you have a question, if you could please put your hand up. I have one over here. If you could tell us your name and your affiliation, and off you go.
Yes, hi, my name's Kate. I'm from Syndex, and we are a tech company. We provide services to the co-op sector. Peter, my question's for you. It's about, you mentioned when you brought the two entities together, they had existing legacy systems and you were able to do away with those, and the answer for you guys, your model has been to go onto a single tech stack, and you mentioned the words that it's got to be, well, for you guys, contemporary, repeatable and secure. So which tech stack did you go with?
We were fortunate in that the main tech stack is Fiserv Signature, is the core, and that's coupled with the other main platform, which is Salesforce as a CRM.
That's excellent. We're also on Salesforce. Just thought I'd mention it. And did you, when you guys looked at those competing tech stacks, was there something about the Salesforce tech stack versus AWS or something else that particularly stood out?
Yeah. So we took, both banks were on a transformation journey. People's Choice were probably 18 months to 2 years further down the track than Heritage was. But Heritage had independently made the decision to change its core and its systems. As it turned out, we had an independent review of the core. We had chosen Signature Fiserv. People's Choice were on an earlier version. We've just upgraded that version. And every other system, we were at 50-50 between AWS and Salesforce. People's Choice had already chosen Salesforce, so that was an easy decision. But then on every other system, we did a no regrets decision. So we put every system against each other. And it was very simple. The analogy that I used throughout that was we had two cars in the garage. We had a Ford and we had a Holden. And you got to choose between the Ford and the Holden. We didn't have a 7 Series BMW. So it was, you choose that one. You might want the 7 Series, it's not on offer. You choose the car that's going to do the job. And that's the decision that we've made, the integration planning platform that we're on at the moment. And we'll get to the 7 Series, but at the moment it's what works. It is the best fit, and we get that up and running, and then we talk about the improvements. And that's worked very well. It takes a lot of discipline, and that's also how we've got the sequencing right. So there's a priority about how the systems are integrated. There's a cost in that, and there's only two things or only one thing really that changes the way that priority works, and that's the regulator. So if the regulator suddenly says something's now you've got to do this, that gets changed. But there's no crazy CEO idea that gets up. There's no crazy board idea that gets up. It's sort of no, you've got to do it this way, and it's got to be in that priority. And if we stick to that discipline, we should be hopefully right. Ask me in a year.
Just been asked to remind everyone, you can ask questions via Slido. You'll see the QR code up there on the screens there if you'd prefer to get your question through that way. We have another question over here, I think.
Yes, Emmanuel Johnson, UTS. Well, we've talked about cybersecurity. We've talked about the core. The next one, obviously AI, and just wondering what how you are getting ready on the future of work front, and if there are scale issues as well, if it's if it requires broader coordination beyond the one bank or not.
So that was the future of work.
Yeah.
Yeah, and working from home, working in the office. That.
And also automatization. I mean, all anything that changes processes because AI is introduced.
AI, yeah. So the AI elements of our approach to it is a little bit like we've approached fintech over the years. So there was a lot. AI is almost like the shiny new thing. Everybody's really interested in it, and much the same as everybody was really interested in fintech a couple of years ago, and there was a lot of investment put into it. But the road is littered with roadkill everywhere because of that. And I think AI is going to be very, very similar to that, where people rush out to put it in. It is still new. It's a new concept. People are still getting their head around it. AI, we think, really only works, and it definitely works. It will have a place, but it only works if the data is right. So you've got to have very, very good data integrity before you rush into AI solutions, because if you go too quick on that, you're going to have a mess. And that mess is going to reflect in very poor customer outcomes, which will undermine the whole alternate strategy about why people should bank with a mutual, for example. Now, there are elements of AI. We use AI everywhere in the business at the moment. It's embedded in our phones, it's embedded in Office 365 that most of us use. We've all got it, but if you're really looking for that big investment in AI, you've got to get your data set right first.
We've got a question here for Saul Eslake. In respect to the Australian economy, what's keeping you awake at night?
Well, nothing is the honest answer. I'm sleeping very well at the moment. But if I were to list things that could potentially go wrong, some kind of external shock that gives us another surge in commodity prices that has longer term consequences. The Middle East is obviously the one that's at the tip of people's minds at the moment, although the market seem pretty relaxed about what that might do to oil prices so far. That's a possibility. The possibility of some kind of financial accident involving financial institutions and commercial real estate, I think is more so than housing at the moment. Commercial real estate is a risk in some parts of the world, not directly in Australia, I don't think, but if it were to happen in another major market, there would be inevitable flow-ons here. The possibility that if we do see a conflict in both the Middle East and the continuing one in Ukraine, that Xi Jinping might think there's a perfect opportunity to make a grab for Taiwan and then confront the Americans with fighting 3 wars at once. You might remember the last couple of times they couldn't fight 1 war successfully in either Iraq or Afghanistan. So, those sorts of things are certainly, from a longer term point of view, something that bothers me is the lack of ambition of our political leaders for the kind of reforms that are necessary to make the economy grow and deliver improvements in people's material living standards over a long period of time. It's not a rerun of the sort of things we talked about in the 80s and 90s and did during that period. Those are once-off things that you can't do again. But it seems to me that while you can't expect a new government to do much because you can't get into government from opposition by promising to do a lot of stuff. John Hewson learnt that, Bill Shorten learnt that the hard way. So I'm not criticising the present government for not having done very much in its first term of office. What bothers me is that they're not really seeking in what's now the second half of their first term of government, to have intelligent conversations with the electorate about what sort of more expansive mandate they want for a second term that history tells us they're likely to get. That wouldn't necessarily keep anyone up at night, but from a longer term, someone who cares about the kind of country and world that our kids and grandchildren, if we end up having any, might inherit, I think that's disappointing.
And that goes to, there's a question here from Elizabeth Crouch about, you know, what do you think about the government's approach to skills and policy addressing our workforce issues? And
Well, being as brief as I can, I think they're doing a better job of it than the previous government.
Right.
You know, that they've given more serious consideration to the way in which the economy is going to change, and with that, differences in the kind of skills and competencies that will be required to meet likely evolving future demands, and that ranges across a whole range of the things from, for example, you know, having zero carbon emissions at one end, to an economy in which there's a lot more the so-called care economy, health and aged care, those sorts of things, whereas the previous government's approach was more along the lines of trying to prevent change from happening at all. And I don't think that would have served us well. It has never served us very well to try and think you can prevent changes that are happening all over the world. So, you know, this government's not perfect, but I think they're making a better fist of it so far than the previous government was.
we've probably got time for one more question from the floor here, if we have anyone with their hand up with a question. So we're just, okay, probably just going to be running it down. Final takers. Okay, well, I was just going to, you know, thank both of you, but before we wrap up, we've still got a few minutes to go, Peter. I mean, just your view on the general economic outlook, productivity. Does the government actually need to do more than do these bite-sized chunks of reform? Because it's been notable that there's been no real consideration to major tax reform, which has always been a problem for any government.
Well, the answer to that is yes, but I don't think that they will, for the reasons that Saul has just articulated. But I think when you look at productivity and the tax system, if you look at the opportunities that we have within the sector for, say, affordable, or tackling the issue of home accessibility rather than affordability, I think that that's an area that we as a sector should be advocating for, but to do that will require some innovative thinking on our behalf, but some legislative change and probably some tax change on the government's behalf.
Right, okay. Look, on that note, I'd like to thank Peter Locke and Saul Eslake for your insights this afternoon. Always great speaking with both of you. So it's always a great opportunity to be able to get the benefit of the wisdom, having worked on, I suppose, both sides of economics and also banking, but a lot of challenges ahead. So I wish you both well and enjoy the rest of the afternoon. I'd like to thank the audience for having us here this afternoon, and thank you. Have a great afternoon.